Hi there. For 14-3, I wanted to start out in the PowerPoint. This is a kind of tough concept, and I know I've been alluding to all semester that you need to know how many days are in each month, and that is going to come up in this unit because we're going to talk about promissory notes, promise to pay, because that's what some companies do if they get in a bind and they owed you something in 30 days and they know they can't repay, but they know that they're going to stay in business and they've just got some catching up to do, or they know they're going to make it during Christmas rush or something like that. You may agree to take a promissory note from them. So basically that would involve interest, because if you're just waiting for them to pay month after month after month, you're really not getting anything from them. So getting them to exchange their accounts receivable into a promissory note is a real good move on your part. So the thing that makes it a little bit uneasy is because they're usually done in days, and all our months have different days. So, and you always don't do them at the beginning of the month. So the first thing that's kind of sketchy is figuring out what the date of payment would be. All right. So this is a real good way, and if you have to sketch it out on a piece of paper, I highly suggest that you do, because it's very hard to figure this out in your head unless you've got a calculator for a brain. So in this particular scenario, the person had a 90-day note, and the note was taken out March 18th. Okay, so on the to figure out the due date, what you would do is figure out, okay, in March, I took the note out in 18. There's 31 days in March. So 31 minus 18 is 13 days. So I had this 13 days in March. Okay. So 90 minus 13 is 77. So I have 77 more days at the end of March remaining in this note. April has 30 days. Okay. So I subtract 30 from 77. And at the end of April, I have 47 days left. Okay. May has 31 days. Subtract 31 from 47. And at the end of May, I have 16 days left, which means that my loan is going to be due on June 16th. That's how to figure it out. Now, if you could figure it out in your brain, you are way smarter than me. So the other thing is, if you'll remember, we did a calculation on figuring out interest rates, and it was interest times rate times time. And that's the other tricky thing here, is if you have something that's a loan for just 90 days instead of 1 year, then you're going to have a fraction in your calculation. So in other words, so I've included this handout for you in this unit to help you figure out some of these harder concepts. But if you look, time 1 year in accounting is 360 days. I know in real life 1 year is not 360 days, but in accounting, according to GAAP, we use a 360-day year, and actually, I think I know why. It's in the bank's favor to do it this way. They get the extra money that way. So you go through it this way. The principal is $5,000. That's the amount that you borrow. If the interest rate is 12%, and the days that you have loan is 60 days, okay, it's $5,000 times 0.12, that's the same as 12%, right? Times 60 over 360, that's the same thing as 1 year. 60, if 1 year is 360 days, then 60 days is the same as 360 over 360, okay? So your computation to figure out your interest rate on $5,000 is 5,000 times 0.12 times 0.167. And that will help you figure out your interest rate. Okay, so hopefully that helps, and then we will go and do our work together. All right, so we got two notes here. The first note is June 5th. It's for $20,000. The interest rate is 8% and the time is 90 days. So we're going to actually start in this block right here. We type in $20,000 here, 8% interest here, 90 divided by 360 here. All right, so let's do the math. I usually do it backwards because I have to take the 90 and divide it by 360 to get my fraction, my percentage. Okay, so the percentage of the year that we have it is 0.25. That's 90 divided by 360. Do it on your calculator. That's 0.25 times 0.08 interest times $20,000 equal 400. So our maturity value is the $20,000 that they borrowed from us plus $400 in interest. Okay. Now let's do the other part. The other part, they got the loan on June the 5th. So in here, how many days does June have? 30. Okay. So if we got it on 5th, we had it for 25 days. Okay. And so 90 minus 25 is 65. Okay. July has 31 days. 65 minus 31 is 34. So we still, at the end of July, still have 34 days to go. August also has 31 days. So at the end of August, we only have 3 days left. So this loan will be due on September 3rd. We put 0 here because we don't have any days remaining. And that is the first loan. Okay. The next one is $10,000, 6%, 120 days. $10,000, 6%, 120 days. Alrighty, and we know it's 10,000 here. All right, so let's get the calculator up. I'm going to start by saying 120 divided by 360. So we've had this a third of a year. Okay, 0.33333 times 0.06 for the interest rate times $10,000. And $200 is going to be our interest. Of course, to get our maturity value is going to be the interest of 200 plus the principal of 10,000. So our maturity value is 10,200. All right, so let's go through. We got this on June the 12th. June has 30 days. 30 minus 12 equal 18. So at the end of June, 120 minus 18, we still have 102 days remaining. July has 31 days. 102 minus 31 is 71 days still left. August has 31 days. 71 minus 31 is 40. We still have 40 days left at the end of August. September only has 30 days. So at the end of September, we still have 10 days left because 40 minus 30 is 10. So we know this loan will be due on October 10th. Okay. Hopefully between this and the handout, you'll be able to figure this out. All right, so on the first one, our interest, if you'll remember up here, our interest was $400. Our maturity date was September the 3rd. And the maturity value was $20,400. That's the principal plus the interest. Okay. And the second one was going to be due on October. Apparently I'm not clicked in there like I think I am. Why can't I type in here? Oh, they want that. Because they don't want letters, they want numbers. The interest on that was $200. Wow, Fran. October 10th is the due date. And our principal plus our interest is our maturity value, so that's $10,200. Alrighty, I'll grade that step. Everything's good. We will go on to the next step. All right, we're going to journalize a couple transactions. Accepted a 90-day 8% note from Gary Kinsey for an extension of time on his account for $1,800. Okay, so what we got to do here is, the first thing we've got to do is convert his accounts receivable, because Gary had an account receivable, see, extension of time on his account. So he had an accounts receivable. We're going to turn his accounts receivable into a notes receivable. So watch how that goes. All right, the date is July 5th. And this is going to become a notes receivable. And the document is in our notes receivable 5. Okay. $1,800. And then it's accounts receivable / Gary Kinney. And so what that's doing, by crediting that notes receivable, it's taking, because our accounts receivable have normal debit balance. So if he had $1,800 debit balance and we credit it out, that's zeroing out his accounts receivable, okay? But instead of paying it, he's getting a notes receivable, which is also has receivables have debit balances, right? So he's just converting one receivable into another receivable, okay? We don't worry about the interest rate on it right now until he pays it, because let's face it, he might not pay it. So we're not going to worry about that until he pays it. All right, the next one. Received cash from Mary Janes for the maturity value of Note 1, a 60-day 9% note for $500. So for this one, let's unpin this. We are going to have to go into our cash receivables. July 12th. And this is notes receivable. Document number is receipt 115. Okay, so this is not an accounts receivable, this is a notes receivable. So that's going to go here in the credit column. And the amount is $500. All right, so the next thing we need to do is figure out what the interest rate is going to be. So we take the 9% times 60 over 360, which is 0.16666, times the $500 value, and you get $7.50. So on the next line, you have to record the interest income, because this is income, interest of $7.50. So he will have paid you, or she, I'm sorry, Mary, pays you $507.50. Okay. The debit is $507.50. You got a credit for $500, a credit for $750, and it balances up. Okay. All right. Last one. I'm going to type a lot of this stuff in because I'm running out of time. I only got a 15-minute limit on this recording. So let me type real quick and then I'll get back with you. Okay, so here we have Dennis Kraft is honoring a note that he took out. He probably had an accounts receivable. He traded in for a 90-day note, and now he's not even going to pay that. So we got to actually turn that note back into an accounts receivable. But this time, not only is it accounts receivable for the $400, but now we have to add the $9 interest that would have accrued in here. So now it's an accounts receivable for $409, and then we credit our notes receivable because we're not going to get that, so we have to credit that out. And interest income, we're not going to get that, so we have to credit that out. And that's the end of this video. I got 3 seconds left. Thank you.